I'm happy to introduce the moderator of our keynote Fireside chat, Cherie Santos-Wuest, who's the managing partner at Celadon Venture Advisors. And Cherie was previously served as principal investment officer with the Connecticut State Pension Fund. And most importantly, Cherie is one of our all-star MVP YaleAREA Conference Committee members and could not have this day without Cherie. So please welcome Cherie with a round of applause.
Thank you so much, Francis. And by that, good morning, everyone. And welcome and thank you again for joining us here at our first in-person real estate conference at Yale since 2019. It's been a very quick 3 years. And it's good to be back in person again. Today we are so pleased and honored to welcome one of the most influential, I think, influential women from the real estate investment industry, Cathy Marcus, who is an esteemed friend and colleague as well. As you can see from your program, Cathy is the global COO and head of U.S. equity at PGIM Real Estate, which is a big title worn on such a small but capable frame. I will not read her bio to you. You could see what she has accomplished over the years and her tenure over at PGIM. But suffice to say, she still has more than earned her stripes in the investment management world. So let's please welcome her today.
Thanks.
So let's get into it. So Cathy, for the handful of folks out there who may not be familiar with PGIM's work, can you please give us an overview of your program, your platform, and the size and breadth of your work in the investment management field?
Sure, and thank you for having me here today. So PGIM Real Estate is the real estate investment management business of Prudential Financial. So PGIM is a large, over $1 trillion asset manager across many different asset classes. PGIM Real Estate is the one focused on real estate. So we have about $205 billion of assets under management across the globe. We focus primarily in the U.S., really pan-Asia. Europe is primarily UK, France, and Germany. And then our Latin American business is primarily Mexico. We run open-end funds, closed-end funds. We do some single client accounts. We have a global real estate securities business as well. And we invest primarily core plus, and value add. Very little opportunistic that we do, and we invest in all asset classes. We'll invest at the asset level, less at the platform level, but it is something that we can do as well.
And so this is within real estate,
yeah.
Asset class alone. I know that PGIM probably has other asset classes like U.S. equities and debt and what have you, but conservatively, you're being very modest. You haven't mentioned numbers in AUM. Across the platforms you just described, roughly how much is your AUM?
In real estate, both debt and equity combined, a little over $200 billion.
It's the GDP of a small state in the U.S. Okay. So, we've just gone through 2.5 years of a pandemic that we're all trying to put behind us. For some, it continues, but we have concretely managed it now, some say. So as we enter the post-pandemic world and also approach the midterm elections, but we'll talk about that later. So what do you see as your topmost issue in the running of PGIM's investment management platform? And you can talk about it from an operational or investment. Both.
So, if you had asked me this question a couple months ago, I probably would have had a different answer, particularly on the investment side. But I would say that just operationally as an employer, the war for talent is really very difficult. And in the more specialized that you get, the more challenging the talent situation is. So that has really been very difficult for us, and something that I personally spend a lot of time on. I also spend a lot of time trying to recruit and retain diverse talent, which is even more challenging because unfortunately there is greater demand than supply right now, and I think that will change as time goes by, but definitely something I spend a lot of time on. From an investment perspective, I think the greatest challenge right now for our platform and really for the industry is, how to invest right now, because obviously interest rates have gone up. We're getting, lots of very clear messaging that they're going to continue to go up, but we don't know where it's going to end. And so it's really, to me, a very challenging environment right now because of the lack of clarity and lack of transparency. And I really had this kind of very unrealistic thought that potentially when we came out of the summer, everything would just kind of fall into place and we'd be able to see around the corner.
Pick up where you left off. And
exactly. And that really hasn't happened. So, I think that from my perspective, we're going to be navigating this, very opaque environment probably for quite some time. And there may be some overcorrection from a cap rate perspective because of the speculation around interest rates, and that may provide some opportunity. Mm-hmm. But to me, that's the greatest challenge is we are still investing, but very selectively. And I would say, when I say we are still investing, we're investing mostly in the U.S. and Asia at this point. Not much going on in Europe. Europe is practically, it still feels like it's August in Europe in terms of the activity levels. It feels like everyone's still on holiday. And in Mexico, also a bit of a pause on our investment activities. I think really just, the interest rate environment is
determining that. And it's interesting because institutional investors like PGIM, usually have a longer term investment horizon, say 7 to 10 years minimum. What would you say your investment horizon is these days? I
would say in most of our strategies, we still have a long-term investment horizon, but let's say that, you bring me, an asset that I want to hold for 7 to 10 years. And to be very extreme, let's say it's an office building, which I don't like generally, and I will say I didn't like pre-pandemic. But what should my exit cap be? What should my interest rate assumptions be?
How do you underwrite?
How do I underwrite? How do I underwrite current debt? How do I underwrite a refi scenario? So it's just very challenging, and it might actually be easier if you were doing something opportunistic and had a very short-term view right now, because it's a little bit easier to see that. Right. Where there is less challenge and actually a huge opportunity is on the debt side, because the banks have virtually disappeared. Interestingly, we had 2 deals come to investment committee in the U.S. last week, and I had never heard of either of the lenders. I'd never heard of them, and they were
Did you lend them through LexisNexis?
They were lenders in the U.S. and they were just small, kind of regional banks that probably had no business doing construction lending.
So you have to underwrite the banks now?
A little bit, and the big, the JP Morgans are not in the market right now. So, and for a while it was like Bank of the Ozark, right, doing all the construction financing. And now, now there are people.
Bank of the Ozark.
Exactly. Even less, household name-ish than that. Yeah, so that's pretty interesting. But that for a group like us, where we have, capital to lend that, really spans all the way from super core, 50% LTV, typical kind of insurance company balance sheet lending, all the way to high yield. And so that we are very busy right now in that space. And I think that those are some of the best returns. We have a core plus debt fund that is currently underwriting at 7 to 9% returns, and it's core plus. It's not
for senior debt.
They're not senior. Oh. If they are senior, they're stretch senior. So you're getting up into the 70s, but 7 to 9 for that versus where the equity returns were. That feels pretty good.
And you feel as if you can actually dictate the terms too.
It's certainly a better dynamic on the debt side. But the thing that's interesting, though, is that while we have so much capital and we want to do lending, generally, lending is precipitated by transactions, and the transactions volumes are way down. So, we're in the refi place right now, but in terms of providing acquisition financing, there's not that much of that right now. And now that may change. I know that a lot of companies waited until September to put assets on the market. We did the same. We put a few assets on the market in September in the U.S., really as a litmus test to see, what may or may not trade in this interest rate environment.
And that, something you said actually reminds me of something Alice Connell, who, is a mentor and a friend, said a long time ago. And you've seen this rodeo before. Yeah. During the great financial crisis when the banks pulled back for a year or two and private equity stepped in. Do you see the same level of opportunity, the same kind of
I think that could happen. I know that there's a lot of money on the sidelines wanting to do, sort of mezz, kind of rescue capital, if you will. And we'll see. I mean, that's always a difficult place to be when you're uncertain about your cash flow. Because as a mezz lender, you want to at least feel like, you're in the game a little bit. Right. Even if you're accruing at the mezz level, you want to see something.
You want to get your money back at some point.
At some point.
Most simply.
And so I think that's difficult right now, although I do think that as maybe in the next 6 months, as things play out a little bit more, people start to understand the market dynamic a little bit. Maybe we have more clarity on where the interest rates settle. Maybe the cap rates settle down a little bit there. You could see where there could be some opportunity there, and those could be very appealing opportunities.
And so you mentioned some issues related to human resource and capital. In addition to that, what are your other challenging issues emerging out of the pandemic world, post-pandemic world?
Well, there's the whole back to the office situation, and that hits us as an employer and also as an owner of office buildings. So I would say that Prudential generally took a very conservative approach to COVID. So we haven't really been requiring people to come back to the office until just after Labor Day, like many other companies. And, so far it's, there's some good offices and some bad offices. And I think it really depends on, some people are not comfortable yet on public transportation, and that impacts some markets more than others. But, it's definitely improving every week. It's improving, and we're still having to buy lunch once or twice a week to entice people back into the office, and I know we're not the only ones doing that. And some of it's just habit, that people are just out of the habit of coming to the office, and then when they come in, and there are a lot of other people there, which that is the key, that you can't come into the office and be there by yourself and sit all day and do Zoom meetings, because then you're like, why did I leave my house? Right. Which I understand. So I think that that's going to improve. And, if I were to guess, everyone's in the office 5 days a week, that's probably part of history at this point. And there's a lot of good things about that. I think that people's work-life balance can be better. It's better for the environment. I mean, there's lots of things lots of benefits that could emanate from that. But bottom line, I'm still a believer in the power of collaboration, and especially as, a young person. I mean, I cannot imagine what it would have been like when I was junior to not have someone right next to me that I could ask a question.
Or that you could see on a day-to-day basis and ask. I mean, knowing which floors the appraisers are on, where their engineers are, and where the lawyers are, actually helps.
Exactly.
Just from my recent history.
Exactly. And I think of all the times when I was young when someone would say, you know what, you can come sit in on this call.
Right.
That was like a last minute, like, oh, I just saw her walk by. You can come sit on this call. That doesn't happen as much when you have to think about it in advance of like, oh, maybe I should invite my analyst to do X, Y, or Z. So I do think it's really important for your career development to be in an office.
And the focus on what you're doing as well, I think it's relatively meaningful. I mean, I've been on conference calls gardening, and that's just not all the time, but that does happen. It's harder to concentrate.
For sure.
And to mentor people.
Yes.
Right?
Yes.
So on the flip side of the coin, there must be opportunities that you've seen in addition to growing your debt platform. What other interesting opportunities and surprises that you've had?
Well, I would say that, the opportunities are yet to unfold, right? And they're coming. And I think that's super exciting because with the exception of maybe the first, 4 to 6 months of COVID, it hasn't seemed like there have been any good buys anywhere. And, very early COVID, we bought about $800 million of industrial properties spread across the U.S. And, we felt like we had, probably a 15-ish% discount at that time. And, and those properties have just appreciated in value tremendously. It was
particularly in industrial.
It was a very difficult decision to invest at that time because it was early enough in COVID that we still were wondering whether people were paying their rent. It was early enough in COVID that we didn't really know how our clients were going to act. Were they going to start to ask for their capital back? So we really took quite a leap, and we worked on this deal for such a long time, and that was ultimately a great decision. And I bring that up because that's the kind of conviction that we're going to have as opportunities start to present themselves now, because we're never going to know when it's really the bottom. We're never really going to know exactly what the recovery is going to look like, what the interest rate environment is going to look like. I mean, are we really just, we were, for a long time, it was, lower for longer. Is it going to be the exact opposite? So, but having the conviction around the property types that are going to be, to outperform, that's really, what we need. And for me, I mentioned earlier that it's possible there'd be some cap rate sort of overcorrection, and really trying to identify what are those sectors or geographies where, cap rates have overcorrected. And, there's a lot of discussion around, CBD office. And, what is the future going to hold for the New Yorks and the San Franciscos, especially given, the back to work struggles, particularly in San Francisco. San Francisco is really very, very behind, very challenged. As a city, actually, also, it's very challenged. But, for me, I feel like betting against New York has never really been a great bet in history.
Yeah. For many institutionals, I don't think it's even a discussion anymore, but San Francisco is a different thing.
Yeah.
So just out of curiosity, I don't know if you caught Jeffrey Dorman's interview, an overview of the NFI Odyssey results 2 days ago.
I did not actually, but I'm a student of the Odysseys.
Well, you live and breathe it, I imagine. I'll see if I can get a replay and send it to you. But the discussion has to do with, how the cap rate compression remains pretty tight for multifamily and industrial. I don't think that's moving much. But for the rest of the asset types, it's different. Just out of curiosity, those industrial deals that did it early on, how many other bidders and financiers were there for that? Did you have a lot of competition?
Well, very interestingly, the deal hit the market pre-COVID, and it was a feeding frenzy.
I bet.
And we tied it up, and then we just kind of schlepped it out over the first couple of months of COVID. So, we felt we renegotiated pretty well, and we were able to because there really there wasn't a long line at that point to buy that industrial.
Still.
Yeah.
Interesting. So there's been a lot of talk about inflation and recession risk. I don't think you can turn on the TV or read the newspaper without running into that. Are there any other factors you're considering in your risk assessment, and how do you factor in inflation and recession risk?
Right.
First, and then I'll ask you about the social unrest issue.
Yeah, well, in terms of inflation and recession, I mean, they're really completely joined up right now. I mean, we're going to fight it, in my view, we're going to fight inflation until we cause a recession. That's kind of seems like that's the dynamic at this point. And, you know, from a recession perspective, you know, it's going to hit real estate. There's no way that it's not going to. There are certain sectors that are more resilient, you know, and that's really where we're trying to focus. And from an inflation perspective too, there are certain sectors that can benefit from inflation. If you think about, you know, shorter lease durations, multifamily, self-storage, hotels, you know, and then there are sectors that have some protection against price inflation. So some of the types of lease structures where you have the pass-through. So, you know, I think you can try to thread a needle in dealing with recession and inflation. I mean, the reality is that when you're a large investment manager, you don't really have the option of saying, I'm just going to sit this 3-year period out, right? You can't do that because people are paying you to invest their money and to create a return in all environments. And it's one thing if your investors, you know, withdraw their capital, but as long as investors have their capital with you, they're expecting it to be invested.
You're working for that management fee.
Exactly. And you know what? People are paying us to take risk on their behalf. And because they've decided that, you know, that we are, you know, well positioned to take risk on their behalf. So, you know, we will be investing in some way throughout, you know, whatever the environment is, even if it's just, you know, really investing in existing assets, but we will be, you know, working the portfolios.
So even in this environment where the Fed is playing pinball with interest rates, your investors are really driving your motivation and your strategy.
They are, and that is, you know, it's very interesting because for those of you who are also students of the Odyssey, the MPI, you know, most of the big funds have exit queues at this point.
We should probably explain what the Odyssey and NPI is.
So NPI is NCREIF Property Index. NCREIF is a, you know, an industry organization that sponsors benchmarks and various index across.
For core specifically.
For core, they also have a Core Plus index now and a Farmland index, but they're really known for their core. So Odyssey is ODCE, Open-End Diversified Core Equity.
Thank you. Yeah. I'm sorry, I didn't mean to put you on the spot.
That's fine. And you know, a lot of the big core funds, in fact, most of them, it's a universe of about, I think now it's 26 to 27 funds in that benchmark, and essentially
among which are PGIM.
Exactly.
The top 3 all the time.
Yes. We actually launched the very first Odyssey fund, which was in 1970, our core fund that's called PRISA. And the universe, essentially, your job and your goal is to outperform the benchmark. And the benchmark is comprised of all of these funds that have certain characteristics that make them eligible and limitations on leverage and guidelines around being diversified and what that actually means.
And it's usually low leveraged in the 25% range. Just so you know, the state funds and all the sponsors, all the pension funds, measure their real estate, their core and core plus real estate against NFI, Odyssey, and NPI as well. So, and this has evolved and kind of broadened over the years.
Yes. When I first started working in that space, meaning I was on the portfolio management team for our core fund, which is when I met Cherie, there were 13 or 14 participants in the index. So it's more than doubled, and it's...
easily.
Yeah.
I think 1 or 2 may have dropped out recently.
Yes.
Not sure. But there are certain rules around these funds in that these are open-ended, diversified funds, but they have something called entry and exit queues. And sometimes, you know, you can't have everybody running away from a fund when the markets are down. So it's interesting to see you can only withdraw so much money. You're essentially, these are for long-term investors. So that's kind of the interesting thing.
And so the reason for kind of the mechanisms for these funds is that generally, and these funds were really originally in the 70s created for pension plans, U.S. pension plans in particular, and that, a pension plan has an asset allocation between different asset classes, and they might want to be, back in the day, 5% real estate. Now it can be closer to 15% real estate. But that's heavily impacted by the equities markets. Okay. So when the equities markets are very volatile, that impacts the capital flows into other asset classes like real estate.
So when the stock markets are down, people tend to look at hybrids like real estate and private equity, and now called real assets.
Yeah. And if you have to be, if you can't be more than 10% real estate, but your, equity securities portfolio has gone down by 20%, that changes your denominator. So we call it the denominator effect. And
I was hoping you weren't going to bring that up, but you live and die by that in the pension fund world.
Yes, and we're now seeing the effects of the denominator effect in that even if people don't want to take money off the table in real estate, they have to, often by mandate and sometimes by legislative mandate if you're managing a state fund. So we do see a lot of unmet withdrawal requests across the Odyssey funds, and that happens from time to time. And the protections in place in these products are very important, because if you were to look at a similar market in the UK, it's since changed, but the UK, their open-end funds, they used to have only a 1-year period of time that they could have unmet withdrawal requests. And then after the 1 year, then they had to essentially fire sale everything.
You have to close it down.
Yeah, which is not fair to the investors who want to stay in. Yeah. And we've never had that in the US. We've always had these protections in place. And, sometimes people are cynical and they may say, oh, it's an open-end fund when you want it to be open. I understand that view, but the reality is that it's for the protection of the investors that want to stay in.
Right, and these investors are, the retirement funds for firefighters, teachers, municipal workers, judges.
Right. Very low risk, investors.
Right, but many of them are underfunded. I shouldn't say all. There are some states that are actually very well managed. I'm so jealous. And this denominator, with the stock and bond markets today, both at an all-time low, you would think that when stock markets plummet, the bond markets rally, but that's actually been for the first time in many years or in decades. They're both suffering. We don't know how long it's going to last, but I imagine there's a push to divert funds towards alternatives in real estate. Are you seeing that yet?
Yes, so to your first point about the relative performance of the debt and equities, or the equities and the bond markets, to me that's just another example of how confusing this time is.
Exactly,
it's very confusing, and that is contributing, I think, to some of the malaise, right? But in terms of alternative investments, so one of the things that we are a little bit concerned about especially in the real estate debt investment side, is that if interest rates continue to go up, then maybe certain debt instruments, non-real estate debt instruments, bonds, become that much more appealing. Whereas part of the reason why there's been so much capital raised to invest in real estate debt is that if traditional fixed income investors moved over to real estate to try to find some return.
Right.
And that may change, and that may have some big capital flows coming out of real estate. Within real estate specifically, the alternatives sector, which really used to be called like the niche properties, student housing, senior housing, manufactured housing, self-storage, anything that, is not kind of the original four major food groups, in real estate. And those sectors during the past, call it 3 to 5 years, have become much more mainstream and much more popular. And they were not, actually. And we have long at PGIM been investors in the alternative sectors, in particular self-storage. We started investing in self-storage in 1998. That was highly unusual for institutional capital, no less institutional, open-end core capital to go into self-storage. And it ended up being truly one of the best
double-digit returns for years.
Unlevered double-digit returns.
Pretty.
I mean, really, really amazing. And the investment thesis that we had at the time was, and these are very old numbers, and I will see if these numbers come back, was that multifamily was trading at kind of a 7, and self-storage was trading at an 8, and it was like, wow, if you look at the durability of the cash flows and you look at the dynamics
and the risk factor
and the fact that they're both kind of low capital versus office, we really loved that dynamic and we loved the excess return. Well, now storage is trading in the 5s, and pre-interest rates it was trading in the 4s, and it's done well. It did really well during the GFC. So I like to think of core investing, or even just assessing the risk of an investment, should not be predicated upon necessarily the use of the asset. Is it an office building or is it industrial? Is it in Manhattan or is it in Des Moines? To me, it just should all be focused on the cash flows. And your view of the cash flows might be influenced by all of those factors, but everything should be driven by the durability of the cash flow. And if you
you're talking about current income, by
exactly, current income and the sustainability of that income stream. And so, for me, I think that if you are looking through that lens and you start to look at things like seniors housing, and you start to look at things like student housing, you start to look at manufactured housing, you're focused on cash flow. And therefore, those don't seem so exotic anymore because you're just reducing everything to a cash flow. Now, obviously, things like seniors housing have a lot of operational leverage, similar to hotels, and you have to really account for that. But we've actually done very well.
But you could say the same about hotels.
Exactly, and you could even say the same, about self-storage. In that way, right? That's an operating business. So, our strategy has always been to partner up with strong operators. And that's really been how we've approached all of these, more niche sectors. And there is a return premium there. Now, less so than there was